Welcome everyone to our channel. We are interviewing experts of all fields to help support you to have the best life possible. And today we have on Jessica Nehme, and she is a mortgage specialist, but she knows everything about money. And so she is my go-to person to ask questions, especially right now. And I'm so excited, Jess, for you to help all of the people that are watching to get the most out of their financial health.
Thank you, Sarah. I'm very happy to be here.
We were talking earlier that in the wheel of wellness, financial health, I think, is overlooked. And, you know, it's such a big part of people's lives, but we talked about how you were talking about how financial stress causes so much physical stress if you are not in a good place financially. So, and frustrating that no one teaches us about these things. We just kind of mimic our parents' spending habits usually, or try and do the opposite, and we don't know about our options.
Yeah. I always joke that you're born into your bank, you know, and it's kind of true because you kind of just go where your parents went, right? Our parents have accounts here and that's just where you go. You kind of, and that's normal in life, right? We mimic our families and we buy and I realized that when I moved out for the first time, I didn't know why I was buying certain things. I just bought it because that's what my mom bought, right? Like, why did you buy that brand of aluminum foil? Because that's the brand my mom buys, right? We just mimic what our parents do, without really any awareness or thought as to kind of how we do life on our own until we do it the harder way. And I think that kind of spreads to everything, including how we handle our finances. We monkey see, monkey do, right? We follow our parents. And if our parents provided us with a great structure or something healthy to replicate, then that's great. But if they didn't, then that's also the nature of life because everyone is doing the best that they can based on the information that they have. And also based on the circumstances of their life, right? We all make the decisions that we feel are best for us at that time based on the information that we have. So it's, you know, and I reflect on this often. And there are, you know, I do want to give credit to, there are some great financial literacy programs out there, especially outside of the school system, that, you know, there's something called, for example, junior achievement. They take professionals out in the workplace and they jump into schools and they spend a day or two in the actual classroom helping kids with financial literacy. And that's great. But I do feel that overall, our education system hasn't really provided a sound understanding around financials, money in general, and credit as a whole. And I really wish it did because I feel that young Canadians are leaving the education system. They're leaving high school, going to university, they're getting their first credit card, and they have no idea how it works. And it all starts there, right? So, and then its habits are built, and we know what it is to have to break a habit once it's been made and used for several years to go into the real world after graduating and have to live your life and make real choices and big decisions. And, you know, then we have to reflect back and sometimes try to fix or undo what was done because we didn't know better. So I'm hoping today that I could add some value. And please feel free to jump in and navigate it as you wish. If there's something in particular that you want to spend more time on, please just let me know.
Sounds good. You decided that understanding credit is the most important thing, especially for business and our financial well-being. So tell us all about that. Yeah.
So I do feel that credit is something that's extremely important. I look at credit bureaus, you know, all day, every day in the work that I do. As you know, I'm a mortgage specialist. So my job is to help people with financing, real estate financing. So whether they are purchasing a new home or refinancing to consolidate debt or to pull out more credit to buy a car or send their kids to school or pay for a wedding or support a family member or deal with a life event, I use real estate as collateral to offer secured lending. So I look at people's credit all day, every day. And I can't tell you how many people don't understand their credit. Sometimes they have great credit and they don't know why. Sometimes they have poor credit and they don't know why. So I'm hoping that I could offer a little bit of insight today. We could spend a lot of time digging really deep, but I'm just going to give you guys some basic information, some pointers, some food for thought, things to think about that will hopefully make a big difference for you. And hopefully you can share this information with others. If you're a parent, you can share it with your kids. If you're, just not a parent, but have a lot of friends, you can share it with them too. And hopefully it adds value. So the first thing I want to talk about is the fact that the credit bureau itself, well, what is it, right? It's a reporting agency that works with lenders. So for example, car dealerships, banks, mortgage financing companies, other financing companies out there, like for example, like a City Financial or something that would offer you multiple loan products. These lenders report your repayment behavior to agencies, and there's two main agencies in Canada, that are Equifax and TransUnion. And these lenders will report typically every 4 to 6 weeks to the credit bureaus. So sometimes, you'll be like, I paid off my whole credit card, but why am I not seeing a change in my credit? Because if you've paid it off and then 2 weeks later have used it all up again, it could be that it all happened within the 4-week span where the lender wasn't reporting to the bureau and it did nothing for your credit. Okay. So number one, having a sound understanding, of what is your financial situation. And we touched on this last time we spoke. What do you have in terms of credit facilities? And give you examples. How many credit cards? Do you have any lines of credit? Do you have any car loans, mortgages? Have you co-signed for someone? This is a huge one, because I can't tell you how many times I'll ask a client, do you have any other credit or any other mortgages? And they say no. And when I pull their credit bureau, there's a mortgage. And they say, well, I co-signed for my son, but that's not my mortgage. He makes the payments. It is your mortgage. This is very important to understand. When you co-sign for someone, as soon as you put your name on that credit application, the lender, regardless of what percentage of ownership you have on that particular product, the lender sees it as you are 100% accountable for this debt as the other parties. So if you are 2 or 3 people, each one of you is 100% responsible. So if one person's making the payments and stops making the payments, it's not a 33, 33, 33 split. The lender will come after each of you for 100% of what is owed. So from a lending perspective, you are accountable. So yes, you do have credit if you co-sign for someone. And that being said, it's important to understand that if you do co-sign for someone, when you have to apply for credit for yourself, the lender will factor in the monthly payment on the debt that you co-signed for as part of your monthly obligations. And it will or could impact your ability to be approved for credit on your end. So do think about that. And I would highly recommend crunching the numbers beforehand, before co-signing for someone, if you feel that you might need some borrowing needs in the future for yourself, because it could impact that. And then you may not be able to get out of that obligation later. Okay. Now the 2 credit bureaus, like I said, they receive reporting 4 to 6 weeks, and they are just machines. Okay. They're not people. They are systems that have been built, and they operate on algorithms. Okay. So there's a formula in place. And as the lenders report these numbers, the formulas are working in the background, and that's how your credit score is generated. Okay. Now, number one thing that the credit bureau algorithm looks at is, are you making your minimum payments? Okay. So we touched on this last time. We said it's not a matter of whether you skip a payment, pay more, pay less. Yes, there's definitely an impact in all of those scenarios. But what's important to the algorithm is that you are paying as agreed. So your lenders are going to report to Equifax or TransUnion, and Equifax being the main credit bureau reporting. Every 4 to 6 weeks, they're going to say, yes, Equifax, we are receiving payments as agreed. And that could be whether it's, a loan structure, so you pay $200 a month, or it could be, it's a line of credit and your minimum is 1% of the balance, for example. Whatever the agreement is, are you making your minimums? So when you look at your finances, as we've said, sit down, make a list, understand what you owe, what are the minimums, when are they due, and what is the interest that you're paying on each of those debts. Really make sure that at minimum, your minimum payments are always made. That is huge for your credit score. Because once a lender sees that you're not paying as agreed, that really does affect your score. And also it stays on your bureau for 7 years after the date of last activity. So if you have a credit card from, that you've had for 15 years and you have a missed payment in 2020, and you stop using that credit card today, 7 years from now, it'll be 7 years before that missed payment doesn't reflect on your bureau anymore.
Wow.
Okay. From last activity. Now, if you have a missed payment, but keep using that card. Oh, bankruptcy is there for 7 years. Yeah.
But I think people think about bankruptcy as being really permanent, but you're talking even one missed payment is permanent.
Yep.
Wild.
It is. It's there. As long as you're using that product, they will always see it.
Wow.
Okay. Because it's from date of last activity. So it'll always be there. And, there is a common sense element to credit, right? Like if there are some times that things happen, right? So sometimes you don't get your statement from your phone bill, right? Or there's an address change and it gets lost in the mail and life happens, right? And lenders understand that there's an overall common sense component to credit. So, I'll have a client that I can see they've got 12 trades, right? Trade lines are what we call, number of credit facilities. And they're on time for everything. And, there was two missed payments in 2014. My client has savings, the good credit, the score is good. It's obvious that was an oversight. We can make sense of that. But if we see, in 2014, five credit lines, 5 different products had 3 missed payments, it's clear that there's something that happened at that stage of life for that person, right? And again, we can make sense of that. But it's just important to understand that information remains visible to lenders. Okay. Think about credit, as no different than if someone were to knock on your door and say, "Hi, Sarah. My name is Joe. You've never met me before. I'm your neighbor. I've just moved onto the street and I'm a good person and I have a job and I'm making a salary. Can I borrow $10,000? And you don't know Joe from a hole in the wall. You're not going to lend him $10,000 on his word, right? You're going to want to know something about Joe. You might say, "Joe, I'll consider it, but I'm going to have to charge you interest to offset my risk because what if you don't pay everything in full? And also, do you have any references of someone that you have borrowed money from before that I could talk to so I can have some peace of mind to know that you actually pay people back?" That's what the credit bureau is. It's your references, right? It's a way for a lender to know this person is good for their word, right? Because not everyone who makes a lot of money is good with their credit. And I can tell you that firsthand, seeing doctors and surgeons making hundreds and hundreds of thousands of dollars every year and don't know the first thing about when their phone bill is due, right? So it's really not about how much money you make or how successful you are, because, we've turned very successful people down for credit because they don't understand how their money works, right? So this is super important. So make your minimum payments, number 1, right? And that really comes down from having a sound understanding of what do you have, when is it due, when does my money come in, and how do I make my payments? That is your responsibility. If you're responsible enough to borrow money, we have to be responsible enough to know and be organized to pay it back on time. Okay? Have a calendar in place. That's super important. And for people who are in a situation where, they don't know what to pay first or how to pay or what's a priority, there's 2 valuable methods that I can offer you. When you've made your list, you can look at 2 things. One is the interest, so which product has the highest interest rate, or you can look at the highest balance. Okay, so math-wise, the smarter thing to do would be pay down the one with the highest interest because you want to pay as little interest as possible. That's a great approach. However, the problem with that is that sometimes we don't see the balance move, because if the one with the highest interest is also the one with the highest balance, it could take us a long time to see movement on that product, and then we don't get that hit of satisfaction to see that our changes are having an impact. And sometimes we need that for confidence to know that we're doing the right thing. So the other approach is to pay down the product with the lowest balance. Okay. Even if it's the lowest interest, right? So always making your minimums, but starting to pay one product down at a time more aggressively than the others to bring it down. So if you feel that you're in over your head and you just need to see progress, pay down the product with the lowest balance so that you can see that go to zero and cross it off your list and move on to the next one.
Cool.
If you are more concerned about making sure, you know, being more money sense wise, pay down the one with the highest interest and get rid of that debt. Okay. While also maintaining your minimums. I also want to mention that sometimes people think, I'm going to have, you know, I have 5 credit cards or, you know, 2 lines of credit and 3 credit cards. And, you know, I want to see 0 on some of these products. So I'm going to pay off everything with 1 and I'm going to max out 1 and leave the rest at 0, or max out 2 and leave the rest at 0. That's not always the best approach. Even though we might think it will be, because the algorithm that's used at the credit bureaus doesn't work that way. So when you are at max, or, you know, max utilization, we call it, it does start to drop your score down. So you might be better off to really reallocate balances. So for example, you know, if you have 5 products, you might want to share the balances on 2 or 3 so that you have 2 or 3 products at 30% of the limit, as opposed to having 2 products at 80 or 90% of the limit and then 3 at 0. Okay. That's how the algorithm works. We don't want to have overutilization because that's one of the hugest things that affect your score. That's super important. An emergency fund is another thing that people have to think about, and that could be starting small. You know, even if it's as little as $50 a month, $30 a month. If you can do $100 a month, that's great, but set goals for yourselves. So, you know, if you want to say, I want to save $1,000, you know, break it down over 12 months and work towards saving that, because it's really, really important to pay yourself first. You have to meet your financial obligations, but you also have to treat yourself as also your own lender and pay yourself too. Okay. Give yourself a minimum payment and give that back to you, because we may not have another, you know, we may not see another pandemic like this in our lifetime, but life does happen. And, you know, we don't know when it's going to change. And I can tell you most of the time, if you look at your life in the last 3 to 5 years, it probably doesn't look the same as it did 2, 3, 4, 5 years ago. Because life happens. You might meet someone, you might have a child, you might, you know, want to buy a house, you might have a sadder story, right? Someone might be ill, there might be a passing away in the family. Life happens and we actually don't see it coming. So it's really important to be prepared, because if we're relying solely on credit, we really don't know where the economy is going to go. We don't know where lenders' positions are going to be. Banks change their guidelines all the time about lending criteria. And if you're waiting to need the money to get access to credit, it might be in a situation where you need the money because you lost your job. And now that you lost your job, you can't qualify for credit, right? So being prepared by having an emergency fund is super important. And the rule of thumb for that fund is to say 3 to 6 months of income is what you should be working towards saving. And if you can't work towards that, if that seems a bit overwhelming, then I would say 3 to 6 months of expenses. Okay. Right. Now, that brings me to my next point, which is spending more than we earn can be tricky. And that happens because we need cars, right? And a car can run you easily $30,000, right? And that's a huge chunk of your income. So it is what it is. We need cars to operate. We need things to live, right? But we really overall, we want to be smart about how we're spending, okay? And if that means sometimes we need to look at alternate ways of making money. Sometimes people get second jobs. There's lots of ways to start saving additional money. Really look at your day-to-day expenditures and see where you can make small changes that will go a long way. Because I will tell you, if you just increase a payment to a credit card by $10 a month, you could take years off your repayment. Wow. Small changes go a long way. Well, yes, when you're paying 20% interest on a credit card, if you change your payment from $40 to $50, you can shave years off of that payment. So, you know, it is worth it to revisit. The other thing I wanted to talk about is, aside from the emergency fund, is if you're in over your head overall and you just, regardless of everything, you're like, I can't make an emergency fund because I'm barely making ends meet. I don't have $10 to spare. I don't have $20 to spare. I don't have $30 to spare. You're in a situation where you need help. This is where I urge you to really look at a debt counseling service.
Mm-hmm.
Okay, they're out there, and that is what they do. They will help you look at your overall financial picture, and they will work with lenders to either reduce what you owe or maybe eliminate the interest. They will negotiate on your behalf, and it happens, right? A lot of Canadians are in over their head because we don't understand. Like I said, we don't have a solid understanding of how to manage it. We go into the world without really understanding money. And then we're distracted by a lot of the things that we feel we need to have. And sometimes it's easy, and it is very easy to get in over our heads, and then we don't know how to dig our way out. And especially if we're okay and we're able to ride the payments because we're doing well, we don't feel it until one day we're not doing well. So there's either a situation globally or just at home that changes the flow of money. And then we realize that we took on more than we can chew. And we need help. So I do recommend that if you don't feel that you can make any of these small changes, reach out to a debt counseling service and let them help you. Okay. They will work with you and set up a plan with a date to have all of this debt dealt with and gone from your life so that you can repair your credit. And you can see it is so possible to make huge changes if you are willing to just face it and get a good understanding of what your financial situation is. Now, if you own a house, you could definitely look at refinancing and taking the equity out of your home if you have it available, depending on property values. And if you are able to qualify and you are still working, you have income, you could look at refinancing your mortgage or taking out a second mortgage to debt consolidate, pay off everything, and have 1 or 2 simple payments every month at a much lower interest rate. Most lenders are charging you anywhere from 6 to 25% interest. If you just refinance into a mortgage, you can reconsolidate everything, and you can reduce your interest overall to maybe 3%, right? Wow. And that's huge, huge savings, right? And if you don't own a house, that's okay too, because we have the option out there. Lenders offer, banks offer debt consolidation, where they take all of your existing debts, they consolidate it into one loan, and then you just pay the bank at something that's probably a third of the interest overall of what you're paying, and you have the same thing, one payment every month, and you can see where it goes. And the benefit of that is that you will have so much more disposable income at your disposal when you consolidate all your debts. Instead of making, $1,000 in payments a month, you can make $600 or $700 in payments a month, and that would free up, let's say $200 to $300. I'm just throwing arbitrary numbers out there, but to give you an example, every month. And with that money, you can start setting aside the emergency fund, or buying yourself an insurance plan that you didn't have before, right? If you have family, this is super important. Do you have adequate life insurance? Do you have adequate critical illness coverage? Because again, life happens, and I have seen it over and over again. I can't tell you how many people have come to me with their mortgages and said, my husband is sick, my wife is sick, this person was the main income earner or the only sole income earner, and we don't have a backup plan. Insurance is super important as a family. I'm not an insurance rep. I'm not legally authorized to sell or talk about it in that way. But what I can tell you is that I highly recommend that you do speak to a licensed insurance broker to have your insurance looked after, because that is a huge component to your financial health. Mm-hmm. And sometimes we're so busy trying to stay afloat in the moment while things are good, we don't really spend the time to make sure that we are prepared when things are not so good. Yeah. So do take a look at your insurance and make sure you have adequate coverage. If you're buying a house, you're taking on $500,000 in debt, you do want to spend $100 a month, $50 a month, $30 a month, whatever coverage that you can get to protect the largest asset that you have and the greatest value, which is you and your family. Okay, so that is huge. That is all I'm going to give you guys to chew on for now, because I think that's a lot. It's a lot to think about, and I hope I was able to give you some insight and some things to chew on. And I think if I just summarize it, the takeaways would be, number one, what is your scenario? take the pen to paper and take this time where we've had to pause on our lives, and really dig deep as to where you stand. What is your total debt? What are your monthly obligations? What is the interest? When are your payments due? What does your income look like? Put it to paper and understand the flow of your finances, okay? Start thinking about how you can save money, okay? Start getting an understanding as to, do you have room? And, if you're in a good situation, let's make it better. And if you're in a not so good situation, let's make it better. There are always options for you. And yeah, just reach out to the right people for guidance, because believe me, there's a lot of people out there who can help you. Financial professionals in your bank, your mortgage agent, mortgage specialist, a debt consolidation company, and order your credit bureau and have a good understanding of it. I told you earlier, I have a client yesterday I was speaking to, and he said to me, I don't understand the issue. I've spoken to 3 mortgage people and I don't know why I'm having a hard time with my credit. And I said, well, what is your credit scenario? And he said, I have no credit. And, he's got a pregnant wife. They're ready to buy their first house and they're great. They're making money. They have stable jobs, but he has no credit. And he said to me, I thought no credit was better than good credit. That's a myth. It is not. Right? Like I told you, the scenario of Joe who knocks on the door. If Joe has no credit, never borrowed money before, how would you know how he handles money? So, we have to understand how Joe repays, and the credit bureau is the way that we can do that. That's how lenders assess your worthiness for credit. So yes, credit is important, super, super important. And it's not necessarily out there, that information, but this is a first step for people to start thinking about it and putting small changes into place that can have a very large impact. So I hope you found it valuable. Let me know if you have any questions.
Oh my gosh. I've been a business owner since I was 16 years old. I never had anyone teach me about money. I was really good with money until you have to make all these expenses and you have to put down payments down, and I bought a house when I was 22. It's way too young. I was way over my head. And
yeah, you don't know what you don't know. Definitely. Right. That's the thing. We don't know what we don't know. And I remember when I first moved, my mom said to me, I said, Mom, why didn't you tell me this? Why didn't you tell me that? And she started laughing and she said, Mama, there's only some things that life was going to teach you that I cannot teach you, that you have to just learn on your own. And she's so right. I never forgot that, because, you learn when it comes to money, you learn pretty quick, right? Like you realize. And I'll tell you, like a perfect example is I moved into my condo, and I think it was in the first 3 months, my car broke down, my fridge broke down, my washer dryer broke down, everything broke down at the same time. And I really was not prepared. And I learned that hard and fast rule about 3 months expenses, 6 months expenses, 3 months income, because I had to figure out how to deal with it the hard way. I had to borrow money at the time that I had taken the biggest loan of my life, right? It was just a huge learning, and we have to learn the hard way sometimes. And hopefully I can help you a little bit today, not learn everything the hard way.
Jess, this was extremely helpful. This is extremely helpful. It's a bit, I know sometimes 30-minute YouTube videos is too much, but this has been so helpful. I'm going to send this to everybody. It's like when you go to the doctor and someone tells a patient, you have to lose 50 pounds. It's extremely overwhelming. People, I think when we're in our 20s, well, for me anyway, you just do whatever. You're out of your parents' control. Maybe you live on your own, and you're just like, I'm going to eat what I want, do what I want, spend time with whoever I want, use my body however I want, spend my money however I want. And even now, if you're making this big income, it's like the same thing I see. If people have a lot of time, that doesn't mean that you're effectively using time. If you have a lot of money, it doesn't mean you're effectively using money.
100%.
And so I think the hardest thing for, that indigo like me, that back in the day was like, well, it's just going to be fine. Like, it'll just be fine. And it's like, no, like,
until it's not.
It's not. And like this resistance to a plan, a resistance to act, because it's like knowing the truth is like uncomfortable, and you're like, shit, this is really uncomfortable, and look at all this debt I have, or look at what I have to deal with. But until you have a plan, like when you have a plan, you're actually free. Now you can do something. And I would say to people, because you're a wonderful person, but I've had lots of bankers that really didn't help me. And I think that it's probably the same people that get personal trainers, right? Maybe the first personal trainer, it wasn't the right fit for them. It doesn't mean that you should stop. So I would say, definitely reach out to you, Jess. You could at least point, if you can't help them yourselves, you'll point someone in the right direction. And
I mean, that's the duality of life, right? There's good, there's better and not as good in everything, right? And then not for maybe they don't know better too, right? Everyone has a learning. That's okay, right? So we just we have to find a good match when it comes to guidance in all things. And I really do believe we don't know what we don't know in life, and sometimes we figure it out as we go. But that's why we're here. We help each other and we share the knowledge that we have, and hopefully it can fall on the right ears. And honest to God, like, financial stress sucks. It's awful. It really affects people in the worst way. I see it all the time. The type of physical impact, emotional, psychological impact that people face when they're in a tight money spot and they don't know how they're going to pay their next bill, and creditors are calling, and it's tough, right? It doesn't feel good for our confidence, makes us feel like we haven't achieved or we're not where we want to be in life. And it's not a good place to be. And, I just want people to know that nothing has to stay that way. It's like, it is possible to make changes. We just need to be informed with the right knowledge and some type of guidance as to what to do from here. Because when we're in it and it's in feels like such a dark space, we don't really know how to pull ourselves out of it until someone comes and tells you, hey, like, it's possible. It really, really is. You could take your credit from being seriously in the dumps to being outstanding in just, a few short years. Or a year or a few months, depending on where your situation is.
Wow.
And I just want people to have options, because, I had a friend tell me many years ago, life is really about options. And if you have options, you won't have as much stress. And having a sound understanding of your credit and having good credit really does give you options, because when life does happen, and it always will, find me one person who has lived a whole life without a hiccup or something happening that was unforeseen, and I will bottle them, because it is not going to happen, right? So we want options in life. Cars break down. You want to feel confident that that's okay. I'll go get a new car, right? If you have a stage of life and you realize you need a new housing situation, whether you're going to rent or whether you're going to buy, people are looking at your credit, right? So landlords are going to look, lenders are going to look. You want to feel confident that you can find the place that's suitable for you and for your family, because you have options, right? You have to remember that your credit is a reflection of your character. That's all a lender has to go on. It tells them, what is your character? Who are you? And how do you handle your promises? Really. So that number, as crappy as it may seem, is a reflection of your character, and that's all a lender has to go on. So we need to take that as seriously in the system and structure that we are living and working in order to be able to succeed in it, right?
I love that, Jessica. Thank you so much. For all the entrepreneurs that are also watching, we have to think about this. Oftentimes we just make enough to pay the bills, and we need to think differently. And sometimes that means making sacrifices. Maybe that means you don't buy as many clothes, you don't buy as much food, you buy different kinds of food, you don't eat out. I think it's so much for me has been about having that spreadsheet and knowing where the money's going, and being like, wow, like, and actually I get kind of proud of myself when I do that, and I realize I spend less than I think I do. Like, I think I make it worse in my head. And so I really appreciate this, Jess. This has been so great. So great. I know people are going to want to have you back on for sure.
Love to. So think about it. If you got questions, stack them, and we can tackle it on another video for sure.
Absolutely. And where can they reach you after this video?
Yes, you can reach me at Jessica Mortgages. It's super simple, at Jessica Mortgages, Jessica Mortgages. You can find me on LinkedIn. You can find me on Instagram. You can find me on Facebook. Those are my 3 main platforms. Reach out to me, guys. DM me if you have questions. If I can't answer them, I'll find the answer. I'll point you in the right direction. But hopefully I can help you out. I'm confident I can. So hopefully I hear from you guys. I'd love to. And I hope I brought some value today.
You really did. Thank you so much.
You're welcome, Sarah. Thank you for having me.
Bye, Jess.
See ya.